cost volume profit analysis, or as we like to refer to as CVP. Okay, how they all relate together from costs to volumes to profits to everything. Okay, time to get started. Objectives here. Again, hoping we talk about different types of cost behavior, how the costs behave, how they all relate to each other. Yeah, from production to sales volume to everything. Again, talk about cost volume behavior. We're talking about things such as, just to break even. Or break even means we haven't made any money. The good thing we haven't lost anything. To zero, not at the starting point. What would happen? Increase if we income increase if we install a new machine, reduce labor costs. These are all a lot of questions companies have, people have, managers have when we talk about how we're going to solve them. Again, the whole point is we have to identify this cost behavior and how we're going to use cost volume profit analysis to make these predictions as accurate as possible. A little review, remember from last class, fixed cost, the cost doesn't change no matter how much you use it. Even if you don't use it at all, you pay the same amount, such as rent. A variable cost would be such as utility bill. One month you might be using a lot of electricity, and maybe the next month not. It won't change. It depends on volume. It depends on how much you use it. A mixed cost is a cost that has fixed and variable elements, such as maybe you're renting a car. It says, okay, you pay every day $20 for the car, plus each mile you put on, it'll be 10 cents. That would be a mixed cost. Stepwise cost, take a new higher cost. Again, here it says where the costs are in a certain range. It says, okay, if we're between these ranges, here's what the cost is going to be. And now this range will be another cost. So when activity increases, but in a nonlinear manner. Again here, a different example of what a fixed cost, a mixed cost, and a variable cost is. Or a stepwise cost. The big thing we're talking about today is, determine cost estimates. Scatter diagram, high-low, regression method. Big thing is how we're going to estimate costs. One way is, use a scattergram or scatter diagram here. Take the change in cost, change in units. It's okay, how much do our costs, start at, where they end at? And same with the units. We obviously start at 0, now 25,000. So here we estimate cost should be about 32 cents per unit. The high-low method says you have to take the highest cost and lowest cost with the highest volume and the lowest volume. So it says right here, change in cost. So the highest cost minus the lowest cost with the highest production in units minus the lowest production. So here we estimate at 25 cents per unit. A lot of times it can be used to find the fixed cost. Okay, you use the equation here. We know the total cost. We know the variable cost. Okay, we do a little algebra here. Move 16,000 on the other side, subtract that, and the remaining cost is going to be your fixed cost. So we know the total cost to produce is units. The fixed cost, we have that element. Then we know each unit we produce, that would be 25 cents per unit. Regression, it's more common, but just be familiar with it. Objective of cost analysis, again, the whole point is that even with regression analysis, that's to determine the fixed cost and the variable unit cost. And again here, remember with each method, it's not that one is better than the other one and one's right, one's wrong. You got to find which method do you think best fits your company. And you got 3 methods here. Okay. We look, we got the scatter diagram, the high-low method, and the regression. And again, like I said, you gotta pick one. Which one do you think best fits your company? What's your product? I can give you an example. One, we talked about earlier. Use the cost equation. Look at certain things here. Again, change the cost of the high point, cost of the low point. And you use a high point, and use a low point. And we see here, this one's going to estimate it, the variable cost, at $3 per unit. Again, fixed cost, since we know the total cost minus the variable portion. Now we know the fixed cost. If you notice, even at the high point and low point, it gives you the same amount of fixed costs. Again, if you want to use a diagram too or a graph here, that's fine. Again, we know it's $5,000 for fixed cost, plus each unit we produce, it'll be $3 per unit. Okay, now we switch gears, talk about the contribution margin. And contribution margin says just how much do we earn every time we sell the product? It's the selling price minus the variable cost per unit. And then a ratio, what's our percentage of the contribution margin from the sales price? So here, every time we know we sell a unit, selling price minus the variable cost per unit, we get $30. The contribution margin now has to cover your fixed costs plus an amount for, of course, to cover then your profits. Okay, now break-even point, it says here, your sales equal your total sales equal total costs. Again, there's no profit and there's no loss either. It can be in units or dollars. And formula could be in units. So tell me every month, the fixed cost divided by contribution margin. I have to sell 800 units per month just to break even. That means I haven't made any money. Okay, but also the good news is I haven't lost any money either. Or break even in dollars. You say, well, I gotta make $8,000 a month just to get to zero. Again, a lot of times it's a good starting point, or it's a goal to reach. Okay, if you want to do an income statement method, that's fine too. And like we talked about, your net income, your profit is going to be zero. And again, you want to do a need to know here. Again, take your sales minus variable costs, $20 per unit. Again, now, getting units. It says here, you gotta sell 20,000 units. Again, for a single product company. Again, a graph, that's fine too if you want to graph it. And change an estimate. Sometimes you might say, well, what's my revised break-even point? In units. Again, a lot of times you're going to round because you can't have, let's say, 0.2 or 0.5 of a unit. You just round it up or down. Look about CVP, cost volume profit. Margin of safety means, okay, sales can go down by 20%. We haven't lost money. If we go below, let's say we hit 21%, we're bad. Or hit 20.5%, it means, nope, now we're losing money. Remember, you can't go up forever. Sometimes you might have some decreases, such as now with the coronavirus going on. I mean, companies are losing money. As well, we're at the safety here. Once we hit over 20%, we're in the red. Again, we've got the costs here. If you want to, write down income statement approach here, that's fine too. Now just writing it out here. Now target income. Here it says, well, I want to make at least $12,000, my target income. Well, here it tells me you got to earn $120,000 and you get to keep $12,000. Or unit sales. To get those $12,000 in your target income, you got to sell 1,200 units. And again here, you want to do an income statement approach here, that's fine too. It's the same information. Again, you just write it out differently. And again, look at the ratio here. Percent of unit selling price exceeds total variable cost. You want to be high here. Maybe a little concerned here. It's only 30%. And again here, to get your target income. So here to get your target income, you got to, to get $200,000, you got to make $2,340,000 in sales. The last one, how many unit sales? Well, to get that, income $200,000, you got to sell 13,000 units. Again, excess expected sales or break-even sales, that's your margin of safety you taught earlier. Again, evaluating strategies. Now again, maybe do some revisions here. Say, well, what happened if we did $30,000 fixed cost? Divide by 40%. Now we see our revised break-even point in dollars. Now, if you're a multi-product company, like most companies, you don't just sell one product. Okay, what you want to do is, CVP, and cost volume profit, is replace contribution margin with composite unit, specific numbers of each product, proportionate to sales mix. So we see here, resulting break-even point for composite unit sales. Composite units, your fixed cost, divide contribution margin per composite unit. And we see here, give an example. Offers 3 haircuts. You get the basic, the ultra, and the budget. We see the sales mix ratio. And we see here the total selling price. All right, composite unit be $160. Okay, you see contribution margin is $160 selling price minus the variable cost of $96. The contribution margin per unit is $64. Again, a multi-product break-even point we see here. So now it says with all these haircuts, just to break even, you gotta give 3,000 haircuts per month. So we see here, each one gets 3,000. So again, let's say 21,000 haircuts you got to give all together. From the basic, the ultra, and the budget. And again, if you have to write down income statement approach here, it says here, each one how much, and how much each one costs. And we see here, the contribution margin equals the fixed cost, which means obviously our net income will be 0. That's our break-even point. And we see here, so the first part, contribution, you always want to calculate the contribution margin per composite unit. So we see here, it's going to be $8. Again here, take the break-even composite units. Here's going to be 80,000 composite units. How much is the break-even point? Okay, overall now, bring it all together. And we have some assumptions here. Remember, all costs here, CVP, variable fixed. They're linear. Again, degrees of operating leverage. Here it says how a percentage change will affect your products or affect your profits. Which fixed costs are being used? Contribution margin divided by pre-tax income. So 3 times here it says. Okay, so 30%. So here it says if Ride increase sales by 10%, what will be the increase in income be? Increase in income will be 30%. That's how you want to work these two together. Remember, cost, volume, and profit means they all relate with each other, from cost to volumes, profits, to sales, to everything. Again, if you want to use it with Excel too, that's fine. All right, class. Hope everyone's doing well. Okay? Let me know if anyone has questions. Thank you.